Credit card debt delinquencies are taking off. New credit card delinquency rates have surpassed their pre-pandemic level. That's according to the Federal Reserve Bank of New York. Now, some banks, like Wells Fargo, have said the surge of card delinquencies could signal a possible U.S. recession. Yahoo Finance's David Hollerith has more on this story. And David, we've been watching this credit card debt continue to rise.
Yeah, Rochelle, I guess the simple answer I would say here is that banks have been tightening lending standards for all loan categories, and they're clearly expecting things to get worse. The country's four largest lenders alone have increasingly been setting aside money for future loan losses. They've stashed away $13 billion for future losses so far this year. That's in Q1 and Q2. I think that banks have a lot of things to worry about right now. And credit cards or credit card delinquencies haven't always been at the top of that list. And the interesting thing now with the New York Fed data, what it has shown at the end of Q2 is that could be changing. So there are two consumer-focused online banks, Capital One and Ally Financial, and their Ally's more devoted to auto lending or auto loans, and Capital One more towards credit cards. But bank analyst Dick Bove has actually changed or revoked his buy rating on both of those companies, sort of highlighting the trend of what's looked like increasing loan losses. And so going back to delinquencies, which you brought up, the situation here is that credit card balances have been increasing, and they're at a historical high right now, and they're a big indicator for delinquencies. And as we saw with Macy's too, higher balances can also mean lower revenues for companies as far as when they get paid on the credit card spending that happens at their retail locations. But so across the board, what we're seeing now is that these balances have risen and delinquencies are also starting to rise, and they're at 2019 levels. They're also coming off of what we would consider a pretty low base in 2021. So it's a situation where, it's a highly debated topic right now in terms of how important it is, at least for banks, in terms of all the other things they have to worry about. But I will point out the interesting thing here is that obviously with student loan repayments coming in October and also new unemployment data coming out tomorrow, there are a lot of other economic indicators that could have spillover effects in terms of what consumers are able to do and how spending has changed. Just anecdotally, I'll also point out that, kind of a trend we've seen from the two largest banks, JP Morgan Chase and Bank of America, is that in past quarters, a theme that sort of has been the resilience of the consumer. And a lot of times this is talked about in terms of, how much money consumers have in their bank accounts, their checking accounts. And, for Q2, I guess what we really heard is that consumers are still resilient, but there's been less of the chatter about seeing the balances at pandemic levels staying the same. And, what's clearly happening right now is that consumers are spending down their balances. And, we're kind of in new territory at this point.
Certainly seems to be the case. We'll be keeping an eye on that. Appreciate you breaking that down for us, our very own David Hollerith. Thanks so much.